Peter Grandich, founder of Peter Grandich and Company, is back to give us investment advice regarding gold, mining, and the markets, and his outlook for the economy. Always a pleasure to have you back, Peter. Welcome to Kitco.
David, the pleasure is always mine when I speak to you. You're one of the finest young journalists I've seen in a long time, so I'm really pleased to be here.
Oh, well, thank you for the compliment, Peter. It's because of guests like you that we have an excellent program. Before we get started on gold, Peter, the most important question we have on our minds, Habs or Tampa Bay, who are you rooting for?
Well, I'm glad that the friends in Montreal didn't have to go through a sweep, but it's all over tonight, my friend.
Oh, it's okay. Well, we'll see. We'll see. But thank you for that. Neither of us are wearing our jerseys, so we'll stay neutral this time. Peter, gold. We know you like gold. We know you like the miners. That's no secret. You've been on the show before talking about how well gold has done for you. But you know who doesn't like gold is Goldman Sachs. In a recent research report, they wrote that gold is no longer a store of value. I'm just going to read a paragraph from the report. We recommended against an allocation to gold, oil, or commodities in aggregate, showing that they were not an inflation hedge and that gold was not a store of value. The S&P 500 index has outperformed gold by 327 percentage points, or 10.7 percentage points annualized over the past 11 and a half years. How would you respond to that?
Well, I'll leave my personal opinions about Goldman Sachs in general out, and I'll just say to you, I think it's very unfair that they are picking a select period, because I can take you back to the start of this millennium and show you that gold for 20 years has greatly outperformed the S&P 500. And if you want to look at history, there has been, and even though we continue to face arguments on new products and Bitcoin and that stuff, until proven otherwise, gold has been the best store of value over many, many years. And I don't see that changing anytime soon.
Okay, I'm just going to add to that because the report goes on. I'm not going to read the whole report, but another point they highlighted, where that actually we highlighted and we covered this in an article, is that they said that since the inception of pricing data, gold has provided an annualized real return of 1%, barely outperforming inflation. Adjusting for storage and insurance costs, the estimated excess return drops to zero. So they really don't like holding gold as a form of insurance or store of value. How would you respond to that? Do you have any response to that? Yeah.
They're being unfair because until 40 years ago, gold was restricted from free trading. And so It has not had the same period of other things that they're choosing to compare it to. And to tell you the truth, I think if you would look at Goldman Sachs' actual track record on forecasting gold, you will probably find that they suffer along with what most of Wall Street suffers from. They treat gold like kryptonite. Like what kryptonite did to Superman, gold does to financial assets. So I don't expect any major financial firm to ever wrap themselves around and be a strong proponent of gold. And so it doesn't surprise me that they would try to selectively pick out a particular situation. And again, it plays into my view here that from a contrarian standpoint, gold has never really been in a better position in my 38 years from a lack of real support, while at the same time, many of the things people are choosing are way, way overvalued. So I'm not surprised at the report, and I also highly question the report, even though I'm only hearing it for the first time when you're sharing with me, David.
Right. All right. We'll talk about your views on equities later on, but let's touch on gold here. What do you mean by gold is a kryptonite of financial institutions? I'm paraphrasing what you said, but what did you mean by that?
We're just never going to see people that sell stocks and bonds for a livelihood sell or get behind a product that really goes against owning stocks and bonds. It'd be like going to a Chevy dealer and asking, do you have the best sports car, the best van, the best SUV? Of course, they will say yes, but they don't. No one maker has all the best, but they're not going to recommend something else. So you're just not going to see the financial service community in general, which makes a living off of financial assets, talk to you about owning something in a very large way that goes against or usually performs opposite of what financial assets do.
Well, you're really not going to like this next statement. I'm really trying. I'm not purposely trying to tick you off now, Peter. I'm just a messenger. I'm going to read the next line. Please comment. I already know what you're going to say, but I'm looking forward to your response. Secondly, the only asset class that hedges inflation on a consistent and reliable basis is U.S. equities. The report noted that U.S. equities have outperformed inflation 100% of the time over any 19-year window. Gold outperforms inflation only about 50% of the time over a 19-year window. So owning U.S. equities, according to them, is a better long-term hedge against inflation. Is that true?
I don't have statistics to argue with you, but this is how I will respond to you.
Yeah.
It has been my feeling that much of the financial service community, which I was once a major part of, is what I have coined the don't worry, be happy crowd. You can toss most of them off the top of the Empire State Building, and all the way down, they all say the same thing. Hey, so far, so good. Okay. We are in the financial bubbles to end all bubbles. So the things that are making the most of the bubbles, equities, are obviously going to be widely accepted and viewed as a can't miss thing. That's why you're in the midst of a financial bubble. I'll just tell you this. If you took the most precious things in my life, other than my Lord and Savior, my wife and my daughter, and said, what would you take from this day on going forward over any length of period past a week or a month? Get them back alive. What's up more or down the least? General equities or gold for the next 6 months or 6 years? I would unequivocally take gold over the equities.
Okay. Well, you did recently in your commentary coin yourself as Petrified Pete. Of course, you're referring to the equity side. You're talking about the mother of all bubbles, which you just referenced. Tell us about why you decided to give yourself this moniker. I know you were bearish, but I didn't know things were this bad, or I've gotten this bad in the markets.
Well, I've been bearish in the sense that while I didn't own a lot of general equities, I still focused on equities, but in particular sectors. First gold, then uranium, then copper. But now I believe outside of one or two of those, and over the next few years, there's a possibility that we will suffer a decline that will surpass or equal some of the worst declines ever in the history in the U.S., because that's how far advanced I think this bubble is. And therefore, even though it may not return anything or pay interest at this point, being in cash to take advantage of eventually those substantially declining prices is now prudent, at least for me. And that's what I speak about when I share my thoughts. So cash has never been a position I've held through this, even when I wasn't bullish on general equities. But by the end of this year, if not sooner, I hope to have it as the single largest part of my portfolio, because I think as we get into 2022 and beyond, if the good Lord keeps me here, I am going to witness one of the worst declines that will not only decline, but unlike previous ones, not bounce back right away as others have.
Just to clarify, when you're talking about decline, you're talking about stocks, right? The S&P, NASDAQ, Dow Jones.
Yes, the general equity market, yes.
What you're describing has already happened to another country across the globe, Japan. In the 90s, the Nikkei bursted and hasn't recovered for 20 years. So it has happened before in a developed nation. Of course, their economic conditions back then were slightly different than ours. But can the same parallel be drawn, Peter? Can something ever similar? Because if you look at the history of the S&P 500 before, what you're describing has never happened to American stocks. We've never had a decline and a failure to recover for more than 2 decades.
You know, we began this program in all seriousness, and I was very serious when I said to you that you're a fine young journalist. And I will tell you right now, 95% of financial journalists aren't even aware of the fact that you just made, which is one of the best points you can make. I believe we're the next Japan. You know, when I started in this business way back in the dinosaur age of the early 1980s, Japan was viewed as what we now view China as coming. It was going to be the next big. It was going to overtake the U.S. It was going to do all these things. And it peaked, and it's never gotten back to that level. And they actually have better economics than we do at this point in time. We don't have enough time in this show to go through all the things that are wrong in this country, socially, politically, and economically. But right. You make a very good point that it is possible. Japan is a good example. And I believe we're going to go down a similar road. But unlike Japan, who had at least a very good savings rate, so even though economically they went very bad, people didn't suffer as greatly because they didn't have, they had savings to call on. Here in America, we don't. We don't even have 10% of Americans prepared to enter retirement in any real fashion. The average American has less than $100,000 saved for retirement. The expectation now is it's $2.7 million to live a so-called decent lifestyle in retirement. And that's one of the biggest untalked about things on Wall Street right now, the unpreparedness for America to reach retirement, especially when people now are living much longer than they used to, and costs in retirement are going up, not down. So I want to commend you for bringing up the Japan thing. It's something that's not spoken about, and you reminded me, and it's a good point to make.
Right. And okay. And just on that note, Peter, I know we don't have all day to talk. Unfortunately, I would love to talk to you all day on air, but we've only got 20 minutes. Can you name just a few socioeconomic problems that the country is facing today that drives your thesis?
Well, I don't think the country, and I only speak for the U.S., I can't speak for Canada or anywhere else, but here in the U.S., I don't think this country's ever been more socially and politically divided, other than perhaps at the Civil War or what really started the revolution, because there was a segment that didn't want to revolt against England. But I don't think we've ever been more socially and politically divided. And it seems to be getting worse every day. We have no middle ground, Dave, left anymore in America. You're either on the kind of left or right or hard right. And there's a cultural war going now that's really impacting people's lives to the point that they can't hide in the house and can't escape from it. And so I believe that's festering at a time when politics, and particularly the leadership in politics, would be incapable of solving any financial woe that would come out of left field, unlike it was able to before. I truly don't believe the Democratic Republican Party could go in a room tomorrow and work out a financial crisis like it has in the past. So we have all of this, plus we have a man that's created monetary heroin. That's all that continues moving the financial markets. And so we are all set for a period of brokenness socially, politically, and economically. And I find the complacency among people, even among professionals, who almost half of them have only been practicing since the last financial crisis. So they don't even know what a negative market's like, let alone a market that doesn't rebound but actually stays down. So there's just so many ingredients to be concerned. And that's why, David, I feel the time has come that even I, who kind of feel I could still be selective here or there, I'm going to own more cash than anything else between now and the end of the year.
Okay, we're going to come back to that cash holding in just a bit. But speaking of things that the Democrats and Republicans can't agree on, among their many disagreements is how to spend money and the infrastructure bill. The debt ceiling is coming up. That might put a loom over how spending legislation might be passed. Do you think that there is a risk, there's even a 1% chance that the debt ceiling would not be raised by the deadline later this month, and that the U.S. could default on its debt obligations, which has never happened before in history, by the way?
Well, I see a photo behind you, which I believe is Vancouver, my second favorite place in the whole world. And I'll just tell you this, the Vancouver Canucks will win the Stanley Cup before there's ever a default on the debt ceiling, even though they haven't won it yet. We've had I don't know what the number is now, Dave. It's 200 and something times that we've approached the debt ceiling, and we go through the same rigmarole, and then we just raise the debt ceiling. So I don't think there's a 1/10 of 1% chance of that happening.
Right. So as an investor, it's not even a concern for you. You're just shrugging it off.
Yeah, that's just political, chipping
because
back
because if it does happen, that's going to bring the mother of all crashes, right?
Well, like I said, I think I'll see a parade for the Stanley Cup behind you before I see that happening.
All right, fair enough. You talked about holding cash earlier in the interview, several times actually. So let's talk about this cash holding. Are you not concerned about your cash being eroded away by inflation?
You know, if cash, if I am not able to put it to work over the next 3 to 5 years, if I live so long, you're right, because inflation is a lot higher than.
You're going to live to 105, Peter. So don't you worry about that.
All right. Well, I've seen what people look like at 105. I don't know if I want to get there, but whether I do or not, wherever the good Lord has planned for me, I will just tell you that inflation is a lot higher than we're led to believe. And even though now we're in this transitory argument and all, it's not going to take much higher in order to change people's views on it. And if you want to talk about another bullish reason for gold, and I also sent you a chart if you get to show it, the very fact that real interest rates with the this tremendous shorts that have been caught in our bond market here is driving the rates down. Once that's out of the way, and once people realize what's really happening here in the States, we'll see a reversal back up in rates. But real interest rates dictate, again, just another one of the many reasons, in my opinion, to own gold.
Okay, so let's take a look at this chart then. Can we pull up the chart that Peter was talking about? Gold launch attempt, or gold's launch attempt, right? So this is a bullish chart. We'll talk about the technicals here. But just going back to your earlier statement, gold is something to buy and hold for the long term. Why wouldn't you just allocate your cash into gold?
Part of it will be, but I believe that mining shares, my ability to hopefully select mining shares, which more times than not, if selected correctly, outperform the actual physical bullion. I will continue to do that. I like to point out, first of all, it's from a very good technician on Twitter named Northstar, and he had put up this, and I think this is anybody that wants to argue long term that gold's in a bearish formation really needs to look at this chart. This is the best, in my opinion, 38 years around technical picture to have. It's called a cup and a handle, and as you can see, the big cup going back all the way as far as that group Goldman Sachs said. We have just a perfect trace out of a cup and a handle, and after the handle is completed, which it looks like we're at this point, you can then get forecasts, for twice as much as that move. So those that talk about 3,000 or 4,000 gold, which was never something that was in my vocabulary, I believe now, longer term, based on this chart, you can now legitimately start to make those type of forecasts, at least from a technical standpoint, based on what your viewers are looking at here right now.
Does this chart indicate to you a timeline for your $3,000 or $4,000 target?
No, that you don't know how long it may stay in one particular area. What it is just telling you is there's a very good opportunity for it to happen. And that's what investing comes down to. None of us know the future.
Is that going to happen before or after the Canucks win the Stanley Cup?
This is going to happen. See, the Canucks are never going to win the Stanley Cup, but that's another story for another day. But this type of pattern, yes, it may not give you a date, but it gives you a very high comfort level. And that's all I think you can ask as an investor. Dave, if I can leave you with one thought that I learned in 30, 80 years, what separates winners from losers. It's not how much you make. It's how much you prevent yourself from losing that'll separate you from the winners versus losers. And this chart is telling me owning gold here has far less risk of losing because of the technical strength it has than if I put up a chart now and shown you some of the crazy stocks and some of the way equities are so far parabolically ahead of themselves and have far more danger of losing 50, 60, 70%, where I believe this gold chart tells me nowhere, anytime in the future that I can look out that I could suffer such a loss in gold.
Yeah. Okay. So in your 30 plus years working as a financial advisor in the industry, have you ever experimented with I would say more complex hedging strategies? I was just talking to an options trader yesterday. He's a covered call option seller, and he says, "Look, wherever the markets go, I make money because it doesn't matter if it's up or down. Writing options, I collect the premium and I take home a paycheck at the end of the week." Have you ever? Gold is one. But what I'm asking, Peter, is gold is one way to hedge against a downfall. Have you explored any other options?
I have. For me, David, I used to see when speaking at conferences all around the world, including that wonderful hotel behind you. And there was always somebody talking about, to investors, you should trade in futures, you should trade in options. And my standard joke was I would go up with my wallet, say, listen, take half, leave me the other half, and promise you won't take my call. Uh, most people have not, most people, individuals, have not profited from futures trading or option trading.
Sure.
I believe it's better to seek out funds that do that and leave it to hopefully experts that do it. And again, I must also point out most people who trade options and indexes, they're not investing, they're gambling. But we don't call it gambling on Wall Street. We call it speculating. But speculating and gambling are both the same thing. And most gamblers lose over time. And I just don't think those are areas. Certainly, I've not been successful, and I can't even count on my one hand people that I know that have been very successful at doing it.
Okay. So suppose, well, I know you work for retirees or people about to retire, pensioners. Suppose I'm 60 years old, I've got a few years left before I retire, and I want to keep let's say I've got $500,000 to invest, and I want to protect my wealth. I want to leave some inheritance for my children and whatnot. What should I do, given that what you said is potentially true? We're going to have the mother of all crashes at some point in the future. How should I be protecting my wealth right now besides buying gold?
Okay, so here in the U.S., again, I can only speak to U.S. residents because that's all we're legally allowed to deal with. I've actually started using a product at one time I used to write about that you shouldn't touch with a 10-foot pole, and that's equity index annuities, because they were a product that was highly sales charged, poorly managed, and poor products placed within them. But over the years, the industry has refined itself, and equity index annuities now, which basically take away some of your upside by also protecting you not losing, say, the first 20% of any decline. If someone has to stay in the market over the next 5 to 7 years for the first time ever, and they've been around 20 something years, they've been something I suggest people look at. They are one of the defensive ways. I think the other simple way is that you simply have to, if you have a very large equity position, you have to consider some of the ETFs and things that benefit if they decline and hope they don't work out. I used to tell people that if you want to treat gold nothing more than insurance, treat it the same way you have fire and home insurance. Most people don't want their home or car disappearing, but we have insurance on it. And many times, like I said earlier, gold goes mostly against the financial assets. And there are more sophisticated ways, and I'm certain there are people more versed on it than me to speak to you about it. But sure. I really think at this point in time, cash, as hard as it's imagined, when it's paying nothing and it seems like everybody else is making money, I think a year or two from now, people are going to be glad that they have some cash.
Well, you did make the right call a couple of years ago about gold, so we'll see if you're right again about cash. Final question, Peter, and before I let you go, this has been a very enlightening talk. Final question: would you ever consider investing in equities abroad, outside the U.S.? Because given the problems in the States, one would think maybe domestic stocks aren't the best place to be. Why don't we go foreign? If we assume that the world operates like a zero-sum game, if one country loses or is in the process of losing, another country must be in the process of winning, right? Would you see the world that way?
Sure. And recently I've spoken about it. I've looked up into your neck of the woods in Canada. There are very comparable industry-led type of companies that perform in similar manners as U.S.-based companies have, but sell at a much more attractive valuation than U.S. companies. I also say, even though I think, there's big trouble ahead for the U.S. with China, China is doing some of the things now in its markets and getting itself in shape to withstand what I think is coming much better without getting into political or military stuff. I would almost, if I had to, I would own Chinese equities before I own U.S. equities. But I really just think cash itself, at least for me, or at least someone that's not going to be around 10 or 20 years likely to make up for lost ground and may only have 3 or 5 years, I think the older you are and the less time you have to keep money in the equity market, the more conservative you got to be going forward here.
Okay. Now, Peter, I know we can talk all day, but unfortunately we can't. You have some excellent thoughts about mining, uranium, topics we've explored in the past, but we can explore with you again in the future to follow up. Where can people read about your work and your commentary on other subjects?
Well, there is a website, petergrandich.com, but I do everything now on Twitter. Even my clients have gotten used to it because I want to be able to speak to everybody once. I don't want anybody getting favorite treatment and all. So Twitter is the best place to see and hear everything that I feel and do.
And your Twitter handle is at Peter Grandich, so just your name, capital P, capital G. Excellent, Peter. Thank you very much for coming on the show today. Great talk. I look forward to catching up with you again soon.
Always a pleasure, David. God bless.
And I hope the Habs win tonight. But anyway, that's just because I'm in Canada. We'll see.
Not going to happen.
Thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe on YouTube. Follow Peter Grandich on Twitter.